Margin calls are coming, and this is what it looks like when so many institutions, hedge funds, and other organizations are not seeing it coming. Because we are looking at phase 6 of initial margin requirements that are now going to go underway in September 1st. Guys, the most important part of this video you have to understand is my name is Andrew, that's Professor Meatball, and we are going to go until the end to explain word for word, ape by ape, retail investor by retail investor, exactly what you have to understand about the margin call squeeze already in progress. So, make sure to slap that like. Make sure that you guys have already taken a look at the giveaways that we often give away on this channel because of watching to the end, of watching for fine details, and for paying attention. Because that's what we do to make sure that we are rewarded in the market. So let's get started. First of all, this final phase of a transition from phase 1 to phase 6 as of 2016 is now $8 billion on September 1st. It's a far cry from the $3 trillion threshold of phase 1. As such, many more counterparties, institutions, hedge funds, and family offices will come into scope. So if they exceed the threshold, margin calls are going to be cascading from smaller institutions that are not prepared for it into larger and larger institutions when the market starts a financial meltdown. So let's make sure that we understand it when we can predict the data coming into our laps. So let's take a look at what we are going to take into account the full language of the question first. Countdown to phase 6. So as of September 1st, 2022, regulatory initial margin, IM requirements will apply to the first time to hundreds of global counterparties that have an average aggregate notional amount, AANA, this will be important later, that exceeds 8 billion euros, or a similar amount in local currency, which is right now parity. So we got about $8 billion right there. A recent panel has recorded in 2021 in November, was streamed in July 5th, 2022. This panel was a financial institution, law firms, and ISTA itself, at about 53-ish minutes, but altogether, they come up with a couple of key terms that will be able to help you guys understand the rest of this video. So what are those key terms? We just talked about AANA. This is a gross notional calculation across uncleared OTC trades per firm. Another way is AANA is what regulators use to determine whether a firm is in scope for IM in phases 5 and 6, which means are they in risk of snapping, of losing everything that they have placed bets against. The ACA, or Account Control Agreement, is providing market participants with a standardized form of agreement for the segregation of independent amounts and uncleared swaps. And finally, I just want to make sure you guys understand what initial margin is. It's in towards the middle. Initial margin is the percentage of the purchase price of a security that must be covered in cash or collateral when using a margin account. If at any point you are starting to hear an acronym or something that doesn't make sense, come back to this part of the video and look at all of these definitions right on screen. So let's take a look at who these panel members are. We had Andrew L. Kaira Jr., founder and managing partner of Eden Point Partners, and Amy Caruso, head of the Collateral Initiatives ISDA, and a couple of other big bank names down below. Fun fact about Acadia, the market-leading risk management platform for the derivatives industry. Let's leave this nugget for people who have some digging to do. Let's take a look. As of September 1st, 2022, regulatory initial margin requirements apply for the first time to hundreds. We already saw that. ISDA estimates that there will be more than 775 counterparties with an excess of 5,400 relationships that may become subject to regulatory IM requirements in phase 6. And finally, preparation for the regulatory IM is complex and resource intensive, involving the bilateral negotiation of new IM documents, the establishment of custodial accounts, and operational preparation for collateral management processing, including margin calculations, margin call communication, allocation, and affirmation, collateral settlement, and reporting. All of this to say is that there's going to be a lot of the same stuff that goes into a regular margin call, but now lowering the threshold for hundreds of brand new organizations that probably have never dealt with this kind of threshold before. So what is the ISDA? Well, I'm just going to play a little GIF here. This is from The Big Short. Right, we want to get an ISDA agreement with Morgan Stanley. So for JP Morgan, the Morgans. As we learned from this now infamous scene in 2015 hit, it's what it's like for retail investors to sit at the big boy table. An ISDA agreement is a standard document that regularly used to govern over-the-counter OTC derivative transactions and outlines terms to apply to become a derivative transaction between two parties, typically a derivatives dealer and a counterparty. So too long didn't read. An ISDA agreement gives an institution, firm, or entity the ability to make significant sums of money by engaging in off-exchange transactions on derivatives and swaps. BNY informs us that ISDA has about 960 member institutions from 78 countries. So is this change coming from ISDA? No. As reported by ISDA, the Basel Committee on Bank Supervision and International Organization of Securities Commissions, or the BCBS IOSCO, developed and finalized their final framework on the margin requirements, and that is why we are talking about it here. So in that vein, we are taking a look at a screenshot from the ISDA website. In short, uncleared margin call rules, or UMR, are created to address the OTC derivatives market, 2008 market crash, implementing new margin requirements for non-centrally declared derivatives. As not to stun the market and to allow members to comply, we are now phasing in from phase 1 to phase 6. And September 1st is some 4 weeks and 5 days, or 23 trading days away, if you want to be more exact. So the phased thresholds for UMR means that with each phase, more and more in-scope counterparties will be affected and been the source of the consternation among market participants. Too long didn't read. Going back to September of 2016, a new set of initial margin rules came into effect. Because of the first phase has the largest AANA threshold set at $3 trillion, there are some few counterparties that came into scope or met the requirements, which explains why we are now hearing about it. Now, it's good timing too. So let's take a look at this fancy chart. UMR placed a phase-in and threshold requirement in counterparties is just how many would be incorporated. And you see from the jump from 319 to 775, that is a ton of counterparties, just a doubling of it in essence. So with phase 6 on the way, the scope has significantly reduced from a staggering $3 trillion in phase 1 to a measly $8 billion from US counterparties. So in the conclusion with the ISDA SIFMA initial phase-in with a white paper of July 2018, ISDA tells us that large dealers spent about 2 to 3 years building out their data for the 2016 phase 1 go live. And so now that we have only 1 month for all of these 300 other counterparties to get their stuff together, all of their paperwork together, it's likely that we're going to see margin calls just in the definition of getting all of this stuff together. People are probably not going to be able to get it all in the same vein as the larger institutions with over 3 trillion. So a look at the phases, and we're not talking about the moon. This is what we started off with in the very beginning. So we had phase 1, right, with about $3 trillion, all the way down to phase 5. That's greater than 8 billion, but less than 50 billion. And now we're taking a look at the final phase, phase 6. Seems all pretty intense, but what does it all mean? On September 1st, 775 counterparties with an excess of 5,400 relationships will be at risk for being in scope of the UMR Phase 6, which means that this is going to be when these counterparties need exchange initial margin and the 50 million threshold is exceeded, and the 8 million and there's the $50 billion threshold, and then the $8 billion threshold that now will be the brand new threshold for whether or not these UMR requirements are actually met. So who is subject to a US non-cleared margin requirements? A party trading derivatives products covered by these rules may be subject to requirements in exchange variation margin VM and IM. So there is a little table here to help you guys understand a bit better. But in general, the standardized initial margin schedule is essentially across the board going to include basically every instrument, every institution, every single holding company that has a large amount of money being traded OTC. So once again, ISDA gave us 5 following basic steps to understand what the AANA of a company is. And we have 1, identify all legal entities that are part of your consolidated group. 2, identify the unclear transactions in all AANA covered products for each of the entities and in your consolidated group for each relevant business day. 3, calculate the total notional amount of AANA covered products in step 2. And then finally, calculate all AANA, notify your counterparties. These derivatives are all in the scope: FX options, non-deliverable forwards, physical FX forwards, swaptions, hedging trades, etc. All seems pretty difficult and cumbersome, but this gives a better understanding for us of when larger institutions brought into scope for IM in earlier phases are able to absorb the implementation timeline in a manner that NISCs for the final phases may not. Consider the significant and far-reaching preparations required for the final phases of IM phase-in, and NISCs, custodians, middleware providers, counterparty swap dealers, and regulators among them must engage in immediate dialogue and planning. Even with the prompt and development of implementation plans, effective compliance may not prove achievable for many NISCs. We're essentially all the way back to when we were talking about margin call requirements all the way back in July and June of 2021. And that is when AMC and GME went absolutely ballistic. So if you guys appreciated this deep dive into exactly what is coming up in the near future in terms of margin requirements and the continued story of the margin call squeeze, please do find your way to the like button and also perhaps down to the subscribe and join button, because all of these people on the end screen here have supported the show, have watched until the end, and have been entered into a giveaway for not only a one-on-one session with me, but also a access to the six-figure portfolio that I have worked on, have sweated over, have researched, and have given to the friendly people that support the show, like you guys. So if you guys want to be eligible for one of those giveaways in the near future, please do hit that follow button on Instagram and Twitter. That's Andrew Mo Money. Do not get scammed by people who have slight variations on my name. It happens way too often on Instagram. So whoever you are, stop it, bots. And all the rest of you, thanks for watching to the end, and we'll see you in the money. Peace.